practice question for exam 2. I will start from question 1 and then go over all the questions. So question 1 here, the complete portfolio refers to the investment in. Complete portfolio is a specific terminology in finance. It refers to a portfolio with a risk-free asset and the risky portfolio. So there's not much room for understanding complete portfolios. It's just the definition. Going forward, second question, the normal distribution is completely described by its mean and standard deviation. Again, this is by definition. There are only two parameters that determines normal distribution. One determines the center, so mean determines the center of normal distribution, and then standard deviation determines the shape of the bell. So we need both of these, mean and standard deviation, to determine a specific normal distribution. So only with mean is not able to determine it. Only with standard deviation is not able to determine it. We have to know both of these. And third question, the market risk premium is best approximated by. So the market risk premium is a concept as well. I think the first 3 questions are all asking about concept. So market risk premium is the market risk in excess of the risk-free asset. So we need to just look at and read all of the options to see which one falls into the definition. So the difference between return of an index fund and the return of treasury bills, this seems to be the right one. The return of an index fund is basically the return of a market portfolio. It can be a proxy for a market return. So index fund is a fund that follows an index. And the return of an index fund is basically the return of a market portfolio. And return on treasury bill is exactly the risk-free asset here. Treasury, and the return on treasury bill is therefore the risk-free return. And then others, I saw returns on small firm mutual fund is not a market return, and return on risky asset is not a market return. Return on highest yielding asset is not market return. So none of the following options are correct. Number 4, both investors and gamblers take on risk. That is true. The difference between an investor and a gambler is that an investor, A, is normally risk neutral. Investors are not risk neutral. Investors are risk averse. B, require risk premium to take on risk. I think this one is correct. So gambler, the main difference between gambler and investors is that gambler can lose all of their money and still feel happy. So their risk preference is very clear, risk loving. So they want to use a small amount of money to bet on even though it's a small chance of winning big, but they're okay with that. So they're not penalized the risk that they're taking. But investors are different. So the more risk that you require or you ask them to take, they will require and demand for higher return. So that is the difference. They are risk averse. So they will in the way of buying things. If the asset has higher risk means that the volatility is high. The chance of winning big is there, but it's low. So so investors, they will still invest, but they will demand a risk premium. Demand a risk premium means that they will pay the price that they're willing to pay is going to be lower because this is riskier. And C, investor knows he or she will not lose money. This is nothing. Well, as long as it's a risky investment, they will have a chance to lose money. And the investor, I think, are aware of that. knows the outcome at the beginning of the holding period. Risky assets investments return cannot be predicted. You can expect return, but nothing can say it for sure, because there is volatility out there, there's risk uncertainty out there, and we are not able to know the outcome at the beginning of the holding period. So moving on, historically, small firm stocks have earned higher return than large firm stocks. When viewed in the context of an efficient market, this suggests that when you see one asset's return is higher than in another one, then we should be aware that the risk associated with that asset could be also higher. So let's see the options that are available to us. Small firms are better run than large firms. Could be, but we don't know. Government subsidies available to small firms produce effects that are discernible in stock market statistics. We're not sure. Small firms are riskier than large firms, so this is very likely in the context of efficient market. And also, we know this. So don't pretend that we haven't learned this part. So small firms are riskier than large firms, and small firms' returns are on average higher than large firms. So they are. So we're just, this question is basically testing that understanding here, that the risk and return, higher risk, higher return, and then small firms has higher return, as well as higher risk than larger firms. D, small firms are not being accurately represented in the data. I think this is irrelevant. Moving on, you have 500,000 available to invest. The risk-free rate as well as your borrowing rate is 8%. The return on the risky portfolio is 16. If you wish to earn 22 return, you should. Okay, so we need to do some simple calculation here. Our portfolio return equals to weight 1 times R1 plus weight 2 times R2. And because weight 1 plus R1, weight 1 plus weight 2 equals to 1, so we can basically replace weight 2 by weight 1, putting 1 minus weight 1 here. Now, if we want our return to be 22% for the portfolio, we just need to figure out the weight W1 for the risky asset and W2 for the risk-free asset. So borrowing rate is 8% plus 1 minus W1 times 16%. Now I need to solve for this equation to solve for W1. Okay, W. I need to open up the bracket here, 8% W plus 16% minus 16% W. And I got 22% minus 16% equals to negative 8% W. And I just need to rearrange it. So W, move it to the left-hand side. This is 6%. So I have 6% divided by 8%, and I need to put a negative sign. And that equals to, get my calculator here. That equals to negative 0.75. So that means 1 minus W equals to 1.75. And I need to use 1.75 times the investment here, which is 875. Invest in risky portfolio, and then negative 0.75 times 500,000 equals to negative 375. So negative means we're borrowing. So we're borrowing 375 from the risk-free asset. So we receive 375, later we'll need to return it. So we receive 375 and use this 375 plus the initial 500,000, add up to 875 invest into risky portfolio. And then to close the position, we need to sell the risky portfolio as well as returning 375 to the risk-free, to close the risk-free asset. So therefore, just looking at here, I think I didn't see the right number for investment in risky portfolio, but I saw 375 here, borrow 375. So that one is correct. And move on, you invest 1,000 in a complete portfolio. The complete portfolio is composed of a risk-free, risky asset with an expected rate of return 16, and a standard deviation of 20%, and a treasury bill with a rate of return 6%. A portfolio that has an expected value in 1 year of 1,100 could be formed if you, okay, all right. So we need to calculate the return first. So the portfolio is have been grow from 1,000 to 1,100. So that means the return is 10%. So using 100 divided by 1,000, and that is 10%. So we need a portfolio equals to 10%, and we're doing something similar to this question. So I'm just copying things down, and I'm changing the portfolio return into 10%. And risk-free return here is 6%. So change it to 6%. And then risky return is 16%, no need to change it. So go down to opening up the bracket. So 6% minus plus 16% minus 16%, W. And here I have 10% minus 16 equals to 6% minus 16 W. So I got -6 here equals to -10 W. So W equals to 6 divided by 10, which is 60%. So we need 60% in risk-free, and 40 is 1 minus 60 in risky portfolio. All right, so we just need to find the right one here. Place 40% in risky portfolio, and then rest in risk-free. So this one is correct. All right, moving down. You invest 1,000 in a complete portfolio. The complete portfolio is composed of this: expected return, standard deviation, treasury. The slope of capital allocation lines forms with the risky assets and risk-free assets is approximately. So we need to calculate the slope of capital allocation line. This is exactly Sharpe ratio. Just need to calculate the Sharpe ratio here. Sharpe ratio is using the market, the risk premium, which is risky assets return minus risk-free assets return, 6% divided by 20. Yeah, standard deviation. That equals to 0.5. So see here in question 9, which of the following arguments supporting passive investment strategy is correct? Active trading strategy may not guarantee higher return, but guarantee higher costs. That is true. Passive investors can free ride on activities of knowledge investors whose trades false prices to reflect currently available information. That is true. Passive investors are guaranteed to earn higher rate of return than active investors over sufficiently long time horizon. We don't know that. The active investors as a whole group, we don't know, but we know that some of them, there are very sophisticated investors, well knowledge, and they could be able to earn higher return. So I think number 1 and number 2 is correct. So we are not able to say that the whole group of passive investors can beat the whole group of active investors. That's why we are not able to select. We cannot select number 3. And why number 1 is correct? So number 1 is correct because usually passive investment strategy or passive fund, they require lower management fee. There's not much maintenance out there to select the stocks. They don't need to select the stocks. They just need to follow the index. For active trading strategies, usually they need to do research, select the stocks, manage the portfolios. So accordingly, they charge higher fee. They charge higher management fee. They have higher commissions. So that is very typical if you go out there and see the fee structure of a mutual fund or pension fund or index fund. Next, the efficient frontier represents a set of portfolio that A, maximize expected return for a given level of risk, B, minimize expected return for a given level of risk. We never want to minimize return, so this is not right. B is not right. Maximize risk for a given level of return. We don't want to maximize risk as well. I think A is right. Maximize return given the given the level of risk. Okay, going down, you are considering adding a new security to your portfolio. To decide whether you should add the security, you need to know the security's return, standard deviation, and correlation. Decreasing the number of stocks in the portfolio from 50 to 10 will likely increase the systematic risk of the portfolio, increase the unsystematic risk of the portfolio, increase return. We don't know whether we can increase return or not, so C is eliminated. Decrease the variation in return the investors faces in any 1 year. We don't know that either. So we only know that very likely the unsystematic risk, which is the firm-specific risk, may increase because we basically reduce the diversification effect here. Next, the potential loss for a writer of a naked call option on the stocks is unlimited. I need to pull up the slides for you in case you forget. So we have a graph, a very nice graph to show the payoff changes of payoff along with the changes of stock prices. So if we are entering into a buy call position, so the upside potential unlimited, downside loss is limited. But if we are on the other side, we write a call, sell the call. So therefore, the loss will be unlimited here if the price is going up. And the chance of price going up is determined by the strike price. If the strike price is way above the current stock price, then the chance, the chance of falling into this category is low, even though there is a chance. So so therefore, entering into a call writer position, you will face unlimited loss. It's just a chance of falling into this category. Could be higher, it could be low, it could be managed by the call writers. And moving down, what is the riskiest transaction to undertake in the stock index option markets if the stock market is expected to fall substantially after the transaction is completed? What is the risky transactions to undertake? Okay, so we have a perception that the stock market will fall substantially. So which means that ST stock prices will go down substantially. So in that case, which position here listed here may be exposed to the highest risk? But in another word, let me translate it. So we'll lose the most. So which position here, which position here will make the investor lose the most of the money? Writing an uncovered call option and writing uncovered put option, buying a call, buying a put. So for both buying a call and buying a put, the loss is limited. So I will need to cross this two, eliminate this two. So looking at these two, now let me show the slides. For writing a call, the loss is unlimited when stock prices go up substantially. So it's not the scenario that listed here in the question. Now go down to put. So this is a put, long put position. So you're buying a put here. So selling a put is just flipping the line. So flipping the line down. So it will be having some sort of return, having some sort of gain here, and unlimited loss when the stock price go down. So it will be this upward sloping, flip it will be a downward sloping. So when stock price goes down, downward sloping line, so unlimited loss if stock price falls substantially. So that will answer the question here. So we don't want, if the price go down substantially, we don't want to have a position that is writing a put. Next, a writer of a call option will want the value of the underlying assets to what? And the buyer of a put options will want the value of the underlying assets to what? So we then need to think about the graph. So the writer of the call option will want the value of the underlying assets. So going back to the plot here, so the writer of the call looks like the payoff looks like this. So they will want the price to decrease. If price increase, they will need to pay. So writers want the price to decrease. And then the buyer of the put, go down here, the buyer of the put will want the price to decrease as well so that they can fall into the left-hand side of this category so they can earn, they can profit. So both writer of the call and the buyer of the put wants the stocks to decrease. Okay, going forward, you invest into the stock and purchase the put option. This strategy is called protected put by definition. So with a stop position and buy the put, long put, these two position combined is called protected put strategy. Next, you own 75,000 worth of stocks and you're worried that the price may fall by year end in 6 months. You're considering using either put or call to hedge this position. Given this, which of the following statements are correct? One way to hedge the position will be to buy put. That is correct. So a protected put. So with a position here and a protected put here, we basically can hedge the downside risk. And one way to hedge your position will be write a call. That is also correct. For this is called covered call. So covered call will also generate profit if stock price goes down. And this one, if major stock price declines are likely, hedging with puts is probably better than hedging with short calls. That is correct. Put, so both strategy, protected put and covered call will let you make profit out of the stock decline. However, the protection offers by right put position is limited. It's gonna give you some protection, some profits when the stock price goes down, but they cannot fully protecting if the stock price decline dramatically. So it has to have, so protected put is better if the decline is gonna be huge. But if the decline is moderate, or less than moderate, mild, then both of these will make you profit. 18, the common stocks of the Avalon Corporation has been trading in a narrow range of around 40% of $40 per share for months, and you believe it is going to stay in the range for the next 3 months. The price of the 3-month put option with an exercise price of $40 is $3, and a call with the same expiration day and exercise price sells for $4. So put selling for $3, call selling for $4. What would be the simple option strategy using put and call to explore your conviction about the stock price future movement? It seems that we want to do some straddle. So let me put up the straddle graph. So the perception here is that the price will be ranging around some certain intervals. So as long as the stock price is not gonna, let me share screen. So straddle looks like this. If you buy a straddle, it's a V-shaped profit. In this case, you want volatility. You want the stock price dramatically goes up or dramatically goes down. So if you sell the straddle, that will be an inverted V. So you want the stock price to fluctuate within a certain range. So we want, in this question, our expectation, our prediction for the stock price is that it's likely to be traded around a narrow range, around $40 for a month. So to profit from that, we want to sell the straddle, so the inverted V. So as long as it's fluctuating within the range, we will make money out of that. So if it's too volatile, like going too high or going too low, then inverted V or selling a straddle will lose money. Sell the straddle. Next, you sell one HP call option, $50 call option, and sell one 50 put option. So this is effectively selling the straddle. The call premium 1.25, the put premium 4.5. Your strategy will pay off only if the stock price is what in August. That is interesting. So the price is 1.25, and then our stock price ST minus 50 we will be paying this 1.25. This is the call position, right? Call, right, would, negative. We're using exercise price 50 minus ST. ST is stop price plus 4.5. So adding these two together, we have a negative and if the stop price is above 50, then we need to pay this amount. And it's above 50, we don't need to pay for this part. We'll just need to receive 4.5 on the put position. So here, if ST is greater than 50, if ST equals to 50, and if ST is less than 50. So if it's equals to 50, then that is 1.25 plus 4.5, and that equals to 5.75. And if it's greater than 50, then this part is gonna be 0. So I'll need to copy this down. So this part will be 0 if ST is greater than 50. And this part is gonna be ST minus 50. This equals to ST minus 50 plus 5.75. And then if ST is less than 50, if it's less than 50, then this part is 0. And the put position only will need to be exercised and need to pay this. So that will equals to 5.75 plus this. And our strategy will pay off only if, okay, so if ST is, I need to add a negative sign here. And a negative sign. It's not hard to tell that if ST is greater than 50, this part will lose money. So we don't want ST to be way too higher than $50. Otherwise, this part will be a negative, will be a pure negative number. So the maximum we can do is make it equal to 0 and figure out what is the maximum, the highest ST that we can bear. So this will be ST, negative ST plus 50 plus 5.75 equals to 0. So ST equals to 55.75. So in this scenario, that tells us that if ST is greater than 55.75, the strategy here that we have, the sell straddle strategy, will start to lose money if ST goes above $55.75. Now we're doing the same thing here down. So negative 50 plus ST plus 5.75 equals to 0. So ST equals to 50 minus 5.75. ST equals to 44.25. So this basically means that we don't want, if stop price is lower than $50, we don't want it to go lower than 44.25. If it's lower than 44.25, that means our strategy will start to lose money and we need to pay. So at 44.25, our strategy will break even. So not gonna lose money, not gonna gain money. But if it's up below 44.25, then we'll need to start to pay. So the range here is 44.25 to 50.75. So as long as the stock price is fluctuating within this range, the strategy will make a positive return, will make a positive profit. But if the stock price move below 44.25 or move above 55.75, then the strategy will have a negative return. It will have a negative, it will need to make a loss. So here, if it's the strategy will pay off only if the stock price is either lower than or higher than. So if it's either lower than or higher than this, the strategy will lose. It will not pay off. Between 44.25 and 55.75, that is what we calculated here. Okay, so move on to question 20. May 17, 2020 price quotation for boring call option with a strike price of 50 due to expire in November is $20, $20.80, while the stock price of borrowing is 69.8. The premium on borrowing November 50 call contract is, if it's selling at 20, then the call option price is 20. And we have to buy 100 every time. So minimum increment, minimum shares to buy is 100. So 20.80 is per share price times 100. Contrast that equal 100 shares. That equals to, so one contract, so buying one contract, buying one call option means we need to buy 100 shares. that is 2080. So we'll need to pay $2,080. Okay, so numerical question here. Fill in all the blanks in the following table. So I need to copy the following table to an Excel file. And calculate it in Excel so that I don't need to manually fill in the numbers. So first of all, calculating expected return. So that equals to this times probability. And equals to the sum. Deviation from mean is this minus, no. Deviation from mean is this minus this. Fix it. Square deviations, square. And then this times probability equals to variance equals to the sum. Standard deviation equals to the square root of variance. All right, so that will be this question. Okay, so next one, the pension fund manager is considering two mutual funds. One is stock fund, another one is bond fund. Probability distributions are as follow. Expected return, standard deviation. The correlation between two funds is negative 0.2. The pension fund will include both stock funds and bond funds and assign a weight of 0.4 to stock funds. Please complete the portfolio expected return, and standard deviation of the pension fund. So pension fund will invest into both stock fund and bond fund. They will invest 0.4, so 40% in stock fund and then 60% in bond fund. So we can just follow the formula here and calculate the portfolio return. RP equals to 0.4 times bonds, stock funds expected return 12% plus 0.6 times 6%. And that equals to 8.4%. All right, next, portfolio variance equals to, I just need to follow the formula here, 0.4 times standard deviation, 20%, 0.2, raise it to the power of 2, plus 0.6 times 10%, 0.1, raise it to the power of 2, plus 2 times the weight, standard deviation, and weight for bond times standard deviation times the correlation 0.1. negative 0.2 equals to 0.0808. And the portfolio standard deviation is this, raise it to a power of 0.5, or taking the square root. That is 8.899%. Okay, so move on to the last question. What is the risk-free rate here on this graph? So risk-free rate is the rate where standard deviation equals to 0. So when you see when standard deviation equals to 0, what is the Y? What is the expected return? That is 3%. 3%. And B, what is the expected return of portfolio O, and what is the standard deviation of portfolio O and the Sharpe ratio of portfolio O? So we just tell them from what we see here. For portfolio O, this is the tangency portfolio here. Its standard deviation is 10%. Expected return is 7.16%. And the Sharpe ratio is 7.16 minus the risk-free rate divided by standard deviation equals to 0.41. Next, what is the slope of the capital allocation line? So the slope of capital allocation line is exactly Sharpe ratio. It's not testing you the calculation, it's just testing the understanding. You need to click slope of capital allocation line is exactly Sharpe ratio. And then why is portfolio O efficient? Here, why is portfolio O efficient? So it is efficient because it is on the efficient frontier, which means that given the same level of risk, there is no other portfolios that can generate higher return. And given the same level of return, there's no other portfolios that has lower risk. So that is what efficient mean. It has the best mean variance combination. Next, why is portfolio O the optimal risky portfolio for investors? It is the best optimal risky portfolio for investor because there is a risk-free asset here, and then this portfolio O allows investors to have the highest Sharpe ratio. Any other efficient portfolio on the efficient frontier are not able to achieve that, achieve the highest Sharpe ratio for capital allocation line. So this is the answer, that portfolio O has the highest Sharpe ratio. And final question, if you invest in a portfolio with 50% weight on portfolio O and 50% on risk-free asset, what is the expected return, and what is the standard deviation, and what is the Sharpe ratio? So it is test. So this portfolio and if with a risky asset and a risk-free asset is called a complete portfolio. So the return R C represents complete, is 50.5 times the return 7.16 plus 0.5 times 3% risk-free return equals to 5.08%. And then the standard deviation equals to risk-free asset has zero standard deviation. So we just need to calculate risky asset standard deviation. This is 10%. Standard deviation for risky portfolio equals to 5%. I think I'm missing something. So, oh yeah. So standard deviation is 10.15. So I need to adjust that 10.15. 10.15. So therefore, this will be 5.07. And then Sharpe ratio is this minus 3% divided by the standard deviation. Equals to 0.41. It has to be the same as the Sharpe ratio for the risky asset here. So 0.41 is this from 0.41 up here. Okay, so that will conclude the review. If you have any questions, feel free to drop me an email.